Hello, in this presentation, we're going to record an adjusting entry for accrued interest within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be entering accrued interest and adjusting journal entry. In order to take a look at that, we're first going to take a look at reports. So we're going to go to reports on the left side. We're going to look for the balance sheet. We're going to take a look at the balance sheet. And then we're going to change the dates to 01/01/21 to 02/28/21. So January 1st, 2021 to February 28th, 2021. We're going to do an adjusting entry for accrued interest. Now this is going to be something that will be more of a standard adjusting entry. So if you're in accounting, if you take an accounting class or something, you'll have these standard adjusting entries that you'll have. If you're working in the business area, if you're a business owner, then the adjusting entries give you a better idea, and they're going to be required to be what you need oftentimes if you're going to get a loan, or if you're working with someone who wants to get your financial statements on accrual basis, then you'll have to do some of these adjustments, and these are going to be the typical type of adjustments that you'll make in order to be on a more of an accrual basis accounting, which is typically better for decision making. So this is going to be a minor adjustment here, but it can be significant depending on the size of the loans. So we're going to have the standard adjusting entries. Just note that most of them have one balance sheet account and one income statement account because they deal with timing, and most of them pretty much never deal with cash. So unlike normal journal entries, which always, at some point in the cycle, every cycle, sales cycle, purchasing cycle, we deal with cash. When we go to these adjusting entries, we typically don't deal with cash. We're dealing with some accrual thing that is going on, some timing difference that we got to be dealing with. In this case, we're dealing with the account. So it's important to know that, because when you go, there's always going to be one income statement account, one balance sheet account. Then you can kind of figure out which of these accounts need to be adjusted. So if we go through these, we can figure out which accounts typically need adjusting. And in this case, we're scrolling down to the loans payable. We talked about the loans payable before in terms of the current and long-term portion of the loan amounts. Now we need to talk about it in terms of what is due for a loan payment. Or I should say in terms of interest on a loan payment. So we broke out the short-term and long-term portion before, but now we're thinking about, is there any interest that we owe on the loan for which we have not yet paid? So to do that, we're going to take a look at our amortization schedule. And again, this is another area where you pretty much have to have an amortization schedule to kind of figure this type of stuff out. We broke out the short-term and long-term portion, so that's kind of like really the difficult part oftentimes in terms of the loan payments. Now we're going to try to take a look and say, is there any of this loan payment that should just be a short term or has already been incurred? So if we go to our loans, we've got these two loans. We're focusing here on this short term loan, this $5,000 loan. We took out a $5,000 loan. And the thing about this one is we don't pay either the interest or principal until the end of it. So at the end, we're going to pay back this $5,152. What we're going to say here is that a month has passed. So this month has passed. We didn't pay anything because we're not going to pay until after 6 months. So, but now really the balance has gone up we really owe at this point in time $5,025 because 1 month has passed, and we have the rent, or you can kind of think of it as rent on us borrowing or using the money. So we borrowed $5,000. 1 month has passed. The rent on that money, not the principal, not paying back the original amount, $5,000, but just the use of it, is $25. So really we owe $5,025 right now. Now what we don't do typically is go in and say, okay, well, we're going to increase the loan principal on our books to what is really owed, $5,025. We like to break out what is the loan amount, the principal amount of the loan, versus what we owe due to interest. So what we're going to do is make another liability account and say there's accrued interest of only $25 at this time. Now, I know 25 isn't a big number, and obviously it's not material to a lot of businesses to have a $25 amount, but the same principle would be there no matter how large the loan is. Interest can be very significant, and we could have a significant amount. So the concepts will be the same no matter what the dollar amount will be. If you're dealing with larger loan amounts, then the dollar amount could be significant to decision making. So we're going to use this to make our adjustment. So what we're going to do is we're going to go back over here. It's going to be current. We're going to owe that interest within the next year's time period. So what we want is another loan payable here that's going to be some type of accrued interest. I typically call it a payable account because that's just what I like to call the liability. So I call it a interest payable account that we'll have up top. And then the other side will be interest expense because we actually use the interest. It's kind of like if we lived or if we used the office building and we pay rent on it. We've consumed it already. We owe the rent. We've consumed the rent. We owe the rent even if we haven't paid the rent, and therefore it should be an expense. Here we've used the money. We've been having the money. We've consumed it in terms of use for our business, and therefore we owe the rent on it. In this case, the rent being called interest expense. So that's going to be the other side. It'll increase the expense, decreasing net income. So to do this, typically for any adjusting entry, we've clicked the plus icon up here. We typically would use the journal entry in order to record these. So the journal entry right here, that would be using debits and credits, and we would debit the interest expense and credit a new account we're going to set up, which is going to be interest payable, a liability, a current liability. Now, if there's only 2 accounts affected though, I'm going to even enter the adjusting entries into a register in order to show that it can be, you can use the registers to do journal entry type of activities. Once we get, it might be even more difficult, however, to do that. Just if you know the debits and credits, you want to probably use the debits and credits, and we will see debits and credits no matter how we do it, even if we enter it into the register. And we'll see that. But it's good to try to use non-debit credit to try to set up systems so that we can have different people doing the data input and not possibly no debits and credits in order to do so. So we're going to close this out and we're going to try to go to the register. We will go to the registers. We will do it. We're going to go to the accounting on the left side and we want to be in the chart of accounts up top. Now first, we know that the chart of accounts, we typically use the cash account, but obviously we're not going to be dealing with cash. We could choose any other balance sheet account. Income statement accounts typically won't have a register because they're temporary. So we can't go to interest expense, for example, because it's a temporary account and the register isn't the same. So we need to set up the permanent side of this adjusting journal entry, which will be the loan payable account, and then go into the loan payable register, and we can enter the adjusting journal entry from there. So to do that, we're going to say we want a new account, and we're going to call it a other current liability type of account. So it's an other current liability account type. And we're going to set it up. It's not quite a loan payable. So I'm going to put it into other current liabilities. Other current liabilities. So, and I'm not going to call it other current liabilities. We're going to call it interest payable. So it's going to be an interest payable account, no description, no sub-account. So it's an other current liability detail, interest payable is what the name will be. It's not a sub-account of any other type of account. We're going to save that, save and close. And then if we scroll down to find that, it's in order typically by account type. So assets, and then specifically the asset of cash, and then accounts receivable, then other current assets, then fixed assets, and then liabilities, specifically current liabilities, or more specifically, accounts payable accounts, credit card accounts, and then other current liability accounts. And here is our interest payable. Nothing's in it right now, and we're going to go to the register and put the first transaction in it through the register. So here it is. We're going to select the drop down now, and note the only option we really have is a journal entry. So we're going to enter a journal entry type of transaction, but not using debits and credits, using the plus and minus register kind of format that QuickBooks will set up for us. All adjusting entries will be as of the end of the month, as of the cutoff date, which is 02/28/21 in our case, February 28, 2021. I'm going to keep the reference number. I'm just going to type in the memo that it's an adjusting entry. And the loan payable is the interest payable is going to increase. So it's going to increase by a huge $25 amount. And then the other side, we just need to say where the other side is going to go. And it's going to go to an expense. We're incurring an expense. So I could select the drop down and find it, and or type in interest expense. So here it is, interest expense. Make sure it's an expense type account and OK. And then we're just going to save and close that. We'll see that the 25 now is in our liability account here. And now we'll go to our reports and take a look at all of this. We'll take a look at the balance sheet and the income statement. So first the balance sheet. So we'll go to reports, left side. We're going to go to the balance sheet amounts down here, the balance sheet account, the balance sheet report, the balance sheet financial statement. Click on the balance sheet. We're going to change the dates to 01/01/21 to 02/28/21. January 1st, 2021 to February 28th, 2021, and run that report. So here is our report. There's the date range. Once again, we're really looking at just the end here, February. That's our date as of date. But it's nice to have the full 2 months so we can see any activity in these accounts. If we scroll down, then we've set up a new liability. It should be in the liabilities section. And if we scroll down, it should be in the current liabilities and interest payable. There it is. Interest payable, $25. So we've increased the liabilities here. We owe more money. We owe $25. So if we think about our loan then, we have the current portion here. If I click on that current portion, there's two things that make up this amount. One's our $5,000 loan, and two is the current portion of the longer term loan. So we have the $5,000 loan here. If I scroll back, I'm going to go back to the report summary. And then we have the 25 here. So that's 5,025. And that's really, if we look at our amortization table, that's the amount we owe. We owe $5,000 principal plus the $25 of interest. So that's the amount there. If we look at the other side, which will be on the income statement or profit and loss statement, we will go to the reports on the left side. We will select the report of the profit and loss, selecting the profit and loss. We're going to change the dates to, once again, 01/01/21 to 02/28/21. That's January 1st, 2021 to February 28th, 2021, and run that report. So here is the report. If we scroll back down, we should see that we should have interest expense. Here's interest expense, 621 in it. If we select that, then we scroll down, we see that 25 there. So here's our journal entry for that 25. If we select that journal entry, note it goes not to the register, but to a journal entry. So even if we use the register, if we look at the detail, if QuickBooks cannot find a form that it uses, like a bill or an invoice that drives the transaction or a deposit, something like that, then it's going to default to the register. So, it's going to default to the journal entry. So even though we entered it into the register, there's no driving form. The register isn't really a document that QuickBooks uses, and therefore QuickBooks wants to drive it with a form, with some kind of data entry form. And so the default, if there is no other one, is to go to the journal entry and use debits and credits. So notice that everything uses debits and credits if it affects the financial statements, but QuickBooks is able to use different forms so we can just input things easier without using them. But it's easier if we know debits and credits, a bit easier. So here's the debit to the interest expense. Notice it didn't put the debit on top. Why? Because of the way we entered the information into a register. So it just did it in order of when we entered it in the register. Notice it doesn't matter. But it might look a little funny to people that are, have been trained relentlessly that the debit should go on the top all the time and the credit should go on the bottom. It really kind of depends on the format. But in any case, we debit the expense and we credit the interest payable there. And there is our journal entry. Obviously, I'm going to close that out. I'm going to go back to our report. And that then is going to increase the expense by that 25 and decrease the net income by that 25. So note that the 25 is not really significant, even though this is to this financial statement, but the interest can be significant, and this principal will be applied to other types of things, which will be significant as well. These adjusted entries, our financial statements aren't quite going to be right. They could be significantly off if we don't do some of these adjustments.